Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions, and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
Hold Japanese property for more than 5 years, and you get taxed at 20.315% instead of 39.63% when you sell. Simple rule, except the government doesn't count those 5 years the way you think it does, and that mistake can cost real money. This is the first video in a new series on this channel, the tax, visa, and legal traps that actually decide whether a Japan real estate investment works out. We've measured yield, hidden ownership costs, mortgage access, and Airbnb regulation here using government data. This time, what the tax office actually does when you sell. Start with the basic structure, because it's simple on the surface. Japan taxes real estate capital gains at one of two flat rates, depending on how long you owned the property. Sell within 5 years of buying, and the gain is taxed at 39.63%. That's 30% national income tax, 9% local resident tax, plus a 0.63% reconstruction surtax on top of the income tax portion. Hold past 5 years, and the same gain is taxed at just 20.315%. 15% national income tax, 5% resident tax, 0.315% surtax. Same structure, roughly half the rates. That small surtax embedded in both rates funds Great East Japan earthquake reconstruction. It applies to every income tax bill in Japan, residents and non-residents alike, through 2037. That's a 1.95x difference in tax rate for exactly the same sale, decided entirely by one number: how long you held the property. So the strategy seems obvious: hold for 5 years, sell after, pocket the lower rate. Most guides stop right there. Here's what they leave out: Japan doesn't measure your holding period the way you'd assume. It's not calculated from your purchase date to your sale date. It's judged as of January 1st of the year you sell, not the actual day you close. Here's what that does in practice. Say you bought a condo on March 1st, 2021. You plan the sale for March 2nd, 2026. By the calendar, that's 5 years and 1 day of ownership. Comfortably past 5 years. But the tax office checks your holding period as of January 1st, 2026, and on that date, you'd only owned it for 4 years, 10 months. Still short term. Still 39.63%. The literal number of days you held the property is almost irrelevant. What matters is which calendar year the sale falls in, relative to your purchase year. The real rule of thumb: if you bought in a given year, you generally need to sell in the 6th calendar year after that, not simply wait 5 years and sell. In this example, that means waiting until 2027, not selling early in the 5th year. Run this against a real number, the same Tokyo investment condo we've used throughout this channel. Bought for roughly 30 million yen in 2021, sold today for 36,870,000 yen. That's a taxable gain of 6,870,000 yen. Sell 1 year too early, and that gain gets taxed at 39.63%, 2,722,581 yen in tax. Wait the extra months to clear the January 1st line properly, and the same gain is taxed at 20.315%, 1,395,640 yen. The gap between those two numbers, 1,326,940 yen, about $8,191, is the price of getting the calendar wrong on a single sale. Same property, same buyer, same gain. The only difference is which side of January 1st the tax office puts your sale on. One more layer: the taxable gain itself isn't simply your sale price minus your purchase price. Eligible costs, brokerage commission, stamp duty, registration fees on the original purchase, get added to your cost basis, which lowers the taxable gain. But for the building portion specifically, Japan requires you to depreciate that cost basis over time. The older the building, the smaller your deductible basis, which makes your taxable gain look larger, even if the market price barely moved. There's a second, separate mechanism that catches foreign sellers specifically, and it hits before you even file a return. When a non-resident sells Japanese property, the buyer is legally required to withhold 10.21% and pay it directly to the tax office. Not 10.21% of your profit, 10.21% of the entire sale price, regardless of whether you made money on the deal. On our 36,870,000 yen example unit, that's 3,764,427 yen, about $23,237, held back at closing, before any tax calculation happens. Notice that's more than double the actual long-term tax owed on this sale. The difference comes back as a refund, but only after you file a Japanese tax return the following year. There's a narrow exemption: if the sale price is 100 million yen or less and the buyer is purchasing it as their own home, withholding isn't required. That almost never applies to an investment-grade unit bought by another investor. One clarification: the withholding requirement is about your residency status at the time of sale, not your visa type or nationality. Become a Japanese tax resident before you sell, and the withholding step disappears. The two tax rates still apply either way. As a non-resident, you're also required to appoint a tax agent based in Japan and file your return by March 15th of the following year to claim back any overwithheld amount. There's a benefit Japanese homeowners use constantly that most foreign real estate investors never get to touch. Sell your actual primary residence in Japan, and the first 30 million yen of the gain is exempt from capital gains tax entirely, no matter how long you owned it. The catch: it requires genuine owner occupancy. You actually live there. An absentee-owned investment unit, rented out to tenants, doesn't qualify. Neither does a unit you visit twice a year. The fix for the holding period trap is almost embarrassingly simple: know your exact purchase date, and don't schedule closing until you're certain which side of January 1st the sale falls on. The mistake isn't ignorance of the 5-year rule. Everyone selling investment property in Japan knows about it. The mistake is assuming it counts like a birthday, 5 years to the day. This matters most for anyone approaching their 5-year mark right now, planning an exit, or timing a sale around a specific closing date rather than a specific tax year. It also matters for anyone who inherited a Japanese property and assumes their own ownership clock started fresh. It usually didn't. We've used this same baseline investment unit in our yield, hidden costs, and mortgage videos on this channel. Worth checking against this one if you're modeling a full holding period return from purchase through eventual sale. The headline rate gap is real: 39.63% versus 20.315%. What decides which one applies to you isn't how long you held the property, it's which calendar year you sell it in. Quick recap of the numbers behind Japan's property capital gains tax. Short term, 39.63%. Long term, 20.315%. Judged as of January 1st of the sale year. Non-resident withholding, 10.21% of the total sale price. That's the real mechanics behind Japan's property capital gains tax, and the calendar trap that catches even careful sellers. Subscribe for more data-driven breakdowns of real estate and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.